We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Kris Bennett and he is with my friends over at passiveinvesting.com. over in Charlotte, North Carolina, which I had the pleasure of meeting basically the whole team here a couple months back. And Kris, welcome to the show. How are you today?
Casey, I am doing well. Thank you. Appreciate it.
Absolutely, man. We're glad to have you here and glad you could take time to share with the listeners a little bit about you all and your business and where things are headed and what the outlook looks like. Now, for those that don't know, passiveinvesting.com has really kind of staked a claim in the passive investing syndication world of just a bunch of different things, really for getting a conference that's basically going on every year that pretty much started from nothing, right? I mean, yeah. I think it's basically just been like, hey, I think you all were like, hey, let's do a conference, and now it's just kind of grown every year. Of course, with Shaquille O'Neal and Barbara Corcoran on at the show this past year.
Yeah, Dan's the one who kind of heads that up. So Dan, on one of the managing partners and founders of passiveinvesting.com, he started the Multifamily Investor Nation, just to give people a background here. So he started Multifamily Investor Nation, I don't know, like 3-ish years ago as of the time of this recording, something like that.
Sure.
And I think it started as kind of like meetups, if I'm not mistaken. But that's how he and I first met, was at his very first meetup in Charlotte, like 3 years ago, something like that, before he actually had bought anything with any partners or whatever in multifamily or in real estate at all. So he and I kept in touch, and that's how. There's more details to it than that, but eventually they wanted to add on a storage team to passiveinvesting.com. So he called me up and we talked, and I had a partner at the time. We had our own like LLC, John Allen and I. We were doing our own smaller deals, looking for deals in Charlotte and whatnot. So he called me up and we formed a partnership and went from there. So John and I co-lead the storage team of passiveinvesting.com. But Dan is the one, so your listeners and viewers and all that, excuse me, might be more familiar with the Multifamily Investor Nation. Then we do a smaller one for Storage Investor Nation, but that's the in-person thing that event that you're referring to. It used to be all online, and this past, when was it? It was June or May, June? It was June.
Yeah, May or June. I'm trying to think. My son was out of school because we came to
it. Maybe it was June. So anyway, this past June, I guess, was the first in-person event for Multifamily Investor Nation.
It was, Dan really outdid himself.
Yeah, it was good.
It was nice. And so I told you earlier before we hit record, that, our listener base is not, we don't get a lot of self-storage discussion on here.
Yeah.
So it's going to be a little bit of a newer topic, not necessarily a newer topic because I think everybody knows what it is, but some of the ins and outs and the intricacies of self-storage investing, or really from the GP side more so than just the investing side of it. But there's a lot of questions that surround like what makes a good spot for a self-storage facility. What's the difference in the, what classes are there? Because I know we've seen some that are that have HVAC, some that don't, some that are multi-level, some that aren't. A lot of them, we see some that used to be old garages, and now people have some, for some reason, they split it in half and put a sign in the yard and said self-storage. So, there's a lot of different elements to this, but I'd like for you just to kind of give us maybe a little backstory, a little kind of idea of where you came from and how you got started in self-storage.
Yeah, that sounds good, man. So I just to give the quick background summary, I started in real estate in 2007. Got my license 2007 August 20th was my first day on the job as a residential broker. We didn't know what was going to happen with recession, right? That was coming up in 08, 09. So I was doing foreclosure work, working with banks and asset managers to list and sell foreclosed properties, and had a lot of war stories from that time. But actually, as a result of that, I didn't realize that you can go out and buy all that real estate, right? And at the time, cash was king. It was really hard to get a loan. So yeah, it was just tough for everybody to kind of see that, hey, things are going to get better. It was a really hard time if your listeners weren't around during that time doing real estate. So anyway, I actually had a bad taste in my mouth from real estate, so I decided to go to school and get a job and go do something else. And that's what I did. Long story short, ended up at UNC Chapel Hill in North Carolina here, and didn't realize that they had a fantastic business school. Oh, are you a Duke fan? Is that why you're wearing the?
Absolutely not.
Oh
I live in Kentucky, man.
Oh, UK. Okay, got it. All right, you're all right. If you're a Duke fan,
so for the listeners who couldn't see me, I was giving him a thumbs down as he was was proclaiming his
about last year
connections to UNC. Oh man.
Anyway, we won't get into all that.
It's all good.
Yeah.
Hey, let's just be friends.
That's right,
man. It's what it is. We'll disagree and agree to disagree.
That's it, man. There you go. And by the way, for your viewers, I'm dressed casual. So usually I have like a polo on that says passive investing. Today I got my workout clothes on. So working from home, it's all good. Anyway, right. So what I was saying was I was at the best university in the entire U.S., UNC Chapel Hill. They have a fantastic real estate program at the business school. And lo and behold, the only job I could find in the summer was as an intern for a guy who was raising capital to go out and buy apartment complexes. And he was raising at the time, like for a 16 property portfolio, I don't know, millions of dollars. And I had never seen so many zeros in my life, on the purchase price and all that. And I was just stunned at what he was doing. That process opened up my eyes to the fact that you can raise capital and go out and buy apartment complexes and buy 150 doors at one time versus a bunch of single family homes. I was like, my mind was blown, to be honest with you. So I had no idea you could do that or how that worked. Nobody ever taught me or talked to me about that or whatever. So just to fast forward here, I worked for a company after graduating, worked for a company that was doing multifamily acquisitions. I was their fancy title here, director of acquisitions, which just means go out and buy deals, find deals to buy. So I was calling apartment complex owners. I was calling brokers and trying to find deals. Couldn't make the numbers work for our strategy. Won't get bogged down into the details of all this stuff. We decided to pivot to self-storage because the guys I worked for had it was about 3 really small deals that they owned or were developing at the time. Small meaning like 15,000 square feet, about 100, 150 units. That's small in storage. We decided to go out and raise a fund and kind of build a story around it. And so that's what we did. It was successful on crowdstreet.com. CrowdStreet was a lot smaller in the early stages at that time. This is about 2016, 2017. So I was able to compare the underwriting, the operations, the market, and the opportunity between multifamily and self-storage. And I just fell in love with storage. I am not the person, if anybody's looking for the person to say storage is the only way, multifamily is the only way that you can make money, that's not me. I'm not one of the gurus trying to sell you a course. So you can make money in the stock market. You can make money doing real estate. You can make money working a full-time job and stocking away money in your 401k. That's how I look at it. So anybody can do it that way. I like storage for the operations and just the opportunity. And that's the way I look at it. So that's a long story short, how I got into it. And then if you want to talk about, hey, how the heck does it work? Like all that kind of stuff, happy to talk about that side of things too.
Well, I guess the first thing that kind of jumps out to me is, so a lot of times, and it's really kind of just it's just kind of accidentally happened this way. We don't necessarily focus on getting people who are past engineers and stuff on the show, but like we've had probably like, I'd say 6 out of 10 people that have been on the show. Well, let's say 8 out of 10 people have been these two things, military or engineers. Yeah, right?
That's funny. Yeah.
And so the engineering element of people that come into this business are into it because it's very systematic. Mm-hmm. It's very replicatable. It's very.
Do you mean just acquiring real estate? Is that what you mean?
Just any type of the syndication kind of stuff.
Got it.
It's where it's duplicatable, like you do the same thing, and it's a very system oriented process, which then leads me to the self-storage part of the whole puzzle. And that almost in a way, at least from the outside looking in, seems to take a lot of the human element out.
Yeah.
Now, obviously, you have to still collect payment and still deal with stuff and still deal with, I guess, dead bodies and self-storage unit. I mean, I don't know, I'm just kidding, but I mean, you got to deal with that stuff, but it seems like it's a lot less hassle, a lot less pressure, and
Yeah.
probably, but what's the give there? Cash flow, IRR, increase in rents? I mean,
No.
because obviously you can't, can you increase rents 3% a year
Yeah.
on self-storage
Yeah.
like you do?
Yeah. So if you, there's a lot that you just said in there. So you talked about the operations of the business, how that works. Earlier on, you talked about, you were asking, how do you even know a good location? There's all different types as well. The 3-story, 5-story climate controlled versus single story. So there's like what we look for, which we can talk about that. But you just now brought up kind of the operations and how it works, and then the returns. So looking at how all that affects everything. So if we look at it from just an operational standpoint, what is self-storage? It's a space, a garage, if you want to think of it that way, with a roll-up metal door typically, that people just put their stuff in. And in my mind, if I was looking from the outside looking in, I am a person who throws away things. I don't like to keep stuff. And so
Correct.
I will never have a storage unit personally. And there's a lot of people that can relate to me out there. They're like, man, I don't understand it. They understand the multifamily like story. Everybody needs a place to live, right? At some point, they either multifamily, they live in an apartment, they go buy a house if they can, like everybody gets that. Even mobile home parks, they understand that, kind of like lower income, generally speaking. They need a place to live, have lot rent, whatever. Like they understand that story as well. But storage is like, gosh, if I had stuff, I just throw it away. I don't want to keep it. Yes, but not everybody's like that. And people utilize storage for different reasons. One is usually they're moving or they're downsizing, or something like that, where they need it for a temporary period of time, maybe 1 month, 2 months, something like that. Then they think, I'm going to get it for 2 months. Some people stick to that plan. A lot of people don't, and they end up staying longer, 6 months, 9 months, a year, because it becomes part of their life, and they realize, oh, actually, I need this space. Another reason people utilize it, which is a more recent reason, is decluttering, making room for home offices and that sort of thing, working from home, etc. So people needed the space during the pandemic, and they still need the space, even though there's that kind of tension right now between going back to work for some days of the week and then working from home for the rest. If you're working from home at all, you need space, you need to clear out some areas, and people are utilizing storage for that. Businesses also utilize storage. When people have change in their life, like death or divorce, the downside of storage, the dark side of storage, I guess, they need space to put stuff. And storage is obviously where they go to do that. And then they end up staying longer than they expect. So at any given facility, roughly half of the people there are long-term users. So anywhere from 9 months to a year or longer, they've been a tenant there. Everybody else is a little bit more transitory there. And so on the operations side, yes, you can remove, like you can have one manager managing 400 units. I've seen it before where you had literally like an elderly lady managing 400 units for an owner. In multifamily, you can't do that, right? If you got 400 units, you look at one person, you're going to have problems, right? You need like 6 roughly to manage that on the maintenance and leasing side. And then in the storage world too, because you're dealing with short-term leases, right? It's a rental agreement. It's not really a lease. It's a short-term rental agreement. It's almost like the Netflix of storage, where you can cancel it, right? And so, I'm sorry, the Netflix of real estate, where you can cancel it when you don't need it and move out. So that enables us to raise rents quickly if we need to in an interest rate environment like we're in right now, an inflationary environment. We can raise rents faster. So the REITs actually reported this week and last week, as of the time of this recording in August 2022, year over year rent growth on average from 15 to up to 25%. NOI growth, 15 to 25% NOI growth. Yeah. So imagine that. That's incredible growth. Now, not everybody is going to realize that growth, because we're talking about publicly traded REITs who have their systems dialed in, right? So that's a little bit different. But the point is that you can see, yes, based upon public data, storage obviously can perform very, very well during an inflationary period, and based upon data, not just me or anybody else saying it. You can go back and look at the returns on self-storage, publicly traded REITs for self-storage, and compare it against all the other asset classes, multifamily, data centers, whatever, manufactured housing. And you can see that storage has performed one of the best performers out there top 3 always, if not number 1, when it comes to the publicly traded REITs and the data that you can download on REIT.com. So there's a couple things there. Like, yes, returns are great. The operations are very simple. I will rent a unit from time to time just to kind of check the comps, and I'll rent units from our own places just to make sure our operations are smooth. I never talk to anybody. Literally, you just go on, you rent online. I make my payments online via text or email or whatever. I just made the payment the other day. You can set it up for auto pay and never even think about it, which is what we try to get people to do. So, so it's a very technologically up-to-date process, really smooth process, typically speaking.
And I have to admit, I've said it on the show before, and it definitely doesn't speak to my intelligence level to some degrees, but we actually have a self-storage unit.
There you go.
And it's $75 a month. It's like a tax, right?
Mm-hmm.
And it becomes this, and literally, like, and let me back up. So I don't have a self-storage unit. My wife has a self-storage.
Yep. Mm-hmm.
And it literally $75 a month, right, is $900 a year.
Mm-hmm.
It might have $300 worth of stuff in it.
Yep.
Maybe $400 if I'm stretching.
Mm-hmm.
And the point of the matter is not the financial part of that, which is just almost embarrassing to discuss. But the point of the matter is Americans or people in general don't want to get rid of their stuff.
Mm-hmm.
Like it's stuff. And it's like, we just have this marriage with like our things, and then we go buy more things, and then, well, what do we do with the old things? Well, no, we don't throw them away. We keep those, and then we go buy more. And then once we've bought enough, it keeps going. So it almost to a certain degree has a feel of a recession proof, or even an economical proof, an economy proof scenario. Because what is $75 a month for, and we're probably on the low end, because our average income here is not extremely high.
Mm-hmm.
We've got a military presence close, so they keep the storage kind of balanced.
Mm-hmm.
But $75 a month, and it's like a gym membership. You hardly recognize that it's gone.
You don't really think about it. Yeah.
Correct. So with that being said, I'd like to transition this discussion a little bit towards what we were talking about, like specifically the asset. Like there has to be a buy box for you all. And I don't want to get into proprietary stuff that maybe you're like, hey man, we've been really finding these deals down on the river.
No, that's fine.
But I'd like to know a little bit about what you all specifically look for. If there has to be a minimum unit count, I'm sure there has to be, and then also transition into the automation. Like you said, you just go online, and a lot of these places are finally getting to that, where you can literally go get a 12 by 12 storage unit and never even see another human. Yeah. Like, period. Yeah. So talk a little bit about the buying strategy, the finding strategy, or whatnot.
Yeah, so we look for our group, we look for deals that are roughly, I'd say 40,000 square feet and larger. 50,000 is really kind of the cutoff, but depending on the market, et cetera. So that's roughly depending on the unit count and how big the units are and small they are, et cetera. But roughly call it 350 to 400 units minimum, something like that. Okay. And then you can go larger from there. So that's really what we look for in good growing markets. So that's the type of facility. It could be single story, all non-climate drive up units. That's completely fine. It could be multi-story. We have those 3-story deals, right? And all climate controlled, really nice Class A type facilities. So we'll look for anything within that range. And because you don't get so there's trade-offs there. So with the non-climate, let's say it's all single story drive up. That's really easy access for customers, and a lot of people like that. Your vendors, think about your painters and other folks. They like to use that type of storage because they get in there in the morning, they open the door, they get their stuff out, they close the door, they leave, they don't come back to the end of the day, and it's really easy to get their stuff in and out. A lot of other customers like that kind of storage because that's all they need. They're storing, whatever it is, and it can stay in a non-climate controlled unit, and they're fine with that. Some other customers, they want maybe the climate controlled units. You can do single story climate controlled units where you just open a door and it takes you into a hallway and you walk in there. And we're actually on a contract on a deal that has a bunch of those kinds of units. We're all single story, climate controlled, first floor, really the only ground floor access. When you get into the 3-story deals, they look really pretty, really nice. But from an operations perspective and an NOI perspective, the higher you go up, the more of a discount that the customer usually gets because it's a pain in the butt to go up and down the elevator. Excuse me. Okay. So you tend to put those larger units on the first floor because that's obviously convenience, right? It's easy to unload and unload. If you're going to get a large 10 by 20, you don't want to be going up to the 3rd floor for that. So generally speaking, you try to put more large units on the 1st floor or the 2nd floor, and then the smaller ones on the top on the 3rd floor. And they usually get a discount as the higher they go. So it really depends on the customer and the area and the when I say area, I mean like the local market and then just the state you're located in. So if you look at Colorado, for example, we own 3 deals in the Denver MSA. In Colorado, typically climate controlled gets a discount to non-climate controlled units. So in other words, if I had 2 units that were ground floor access and one was kind of in one of those hallways and it's climate controlled, usually that's like a 5, maybe 10% discount to a non-climate unit because the weather in Colorado is dry and pretty comfortable most of the time, right? And you don't really need to preserve your stuff like you would like in a humid area like in Florida. So that's kind of, we'll look at everything, 40,000, 50,000 square feet and above. It's great if it has some land to expand on. It's really good if it's been run by or owned by someone who's not keen on the self-storage business. Sometimes in that range, you're looking at institutional type deals when they're that size, but they can be built by like a developer or somebody else who they don't like do storage. They built this deal one off. They had some extra land. They built this deal one off and they're just, they're going to just sell it because that's what they want to do. And they want to go build other things. So we see that pretty often. And then for your listeners who might want to jump into business on like a GP side, heck, you can make good money. The deals I've done in the past for like that first company I worked for out of school. We did only small deals, 30,000 square feet or less, like in growing markets, right? But 30,000 square feet or less, you might pay $1 million, $2 million, $3 million for one of those. But those deals can make money. It's a little bit tighter because depends on how you're going to run it. If you run it manned or unmanned, with a call center and all that, there's different ways to do it. But the point is you can take those real mom and pop operations and improve them. And by adding in some tech and et cetera, and really make a good amount of money on those as a percentage of the purchase price. So yeah, there's opportunity across the spectrum, I think, but we avoid deals. People have made money on deals in very tertiary markets. I know people who do those kinds of deals just fine and they work. But we personally don't buy those kinds of deals. We want to buy in places where population is growing and there's an diverse economic market there and a base there. That's where we look for deals.
How many markets are you in right now specifically?
As far as deals that we own, we're in like 1, 2, 3, 4 right now, if I remember off the top of my head. And we started last year in 2021, we raised our funds. In the first 14 months, we closed or put, call it, I don't know the numbers exactly, but call it a little over $100 million closed on and under contract, something like that.
Gotcha.
In storage.
Okay. Now, how involved, I know we've heard basically everything, so I want to kind of cut the operations talk and the physical asset talk and talk a little bit about the capital side.
Sure.
And again, I know you became the part of the arm of passiveinvesting.com's or you were the self-storage arm of passiveinvesting.com, but how involved are you on the capital raising side? Because you've used the word fund a time or two, which obviously proves to me and my listeners that there's a fund of some kind there, which I'd like to get into maybe some of the a high level overview of some of the workings of that, because raising capital is a very important part of this business. So I'd like to know a little bit more about what your involvement is there, or maybe that's why the partnership exists, was because you were really good at the self-storage part and Dan maybe or whoever was really good at the capital raising, but whatever kind of insights you can give us on that.
The way you described it just there is the way it is. I'm sorry. So we'll get involved a little bit on like I have an investor call coming up here pretty soon. Some folks reached out and said, hey, we want to learn more. I did a webinar the other day and that's why they reached out and for our Storage Investor Nation. So they sat in on the webinar and they wanted to learn how to invest with us. So great, no problem. Happy to talk to them and answer questions directly, because they sometimes want to talk to us directly and, ask their questions. Sure. It's no problem.
Ask their questions maybe about operations and stuff.
Exactly. Yeah. Whatever it might be, which is completely fine. So we do get involved with some of the investor Q&A from time to time, but generally speaking, on the capital raise, like the specific with the email list and blasting out and that kind of stuff, like I don't have anything to do with that. I'm the deal hunter, the broker relations, the guy who's making relationships with other owners, institutional owners, to see if they want to sell in the future, if they want to do a deal off market. So that's my specialty. And John, my business partner, he's on the corporate finance side. So he used to do all of our underwriting. We've hired an analyst to do that for us now, but he's on the corporate side looking at, hey, should we sell? Should we not? And closing our deals and that sort of thing. So yeah, that's why we formed the partnership. But we do have a fund. We're on our second fund right now. Our very first deal, we syndicated that one. That was in like March or something like that of 2021. We're actually getting ready to list that one for sale now. It's done super well. We added on another 22,000 square foot building to it. We're going to put that on the market here pretty soon. But that one will be sold here by the end of this year, hopefully. And then the rest of the deals that we did, so call it $80 or $90 million, we've closed on, and that was our fund one. So we raised, I think it was roughly 30 million, a little over 30 million, almost $40 million in equity from limited partners to put into self-storage. So if they came in and they invested in our fund, they're invested in, I forgot the number, 8 or 9 deals across different markets. And so their money is diversified that way. We're on fund 2 now, a bit smaller fund because of these economic times. We wanted to be able to move quicker if we needed to, and raise capital quicker, et cetera, and deploy it faster. So we did our fund. We're doing our fund 2, which we're going to close as of the time of this recording. We should close that next week here in the middle of August. Fund 2 is a $30 million total acquisition price and roughly, call it $15-17 million raise on that one. We are going much more conservative on the LTC just because of interest rates, et cetera. So, but sure. Yeah, that's where we're at. So we do a fund model with it and allow investors to diversify across a couple of assets. And yeah, that's how we do it. I've done syndications in the past, but I prefer a fund model where it's a large fund or a small one, either way, because it makes it easier when you talk to sellers and brokers and to say we have a fund, so they understand that, hey, we have the capital commitments in hand and we're able to close the deal. That's kind of important. So anyway, that's how we have it structured.
Awesome. That's great. Well, and the fund, so walk us through. So you've got a broker relationships. Broker calls you and says, "Hey, Kris, I got this deal. It's whatever you underwrite it. It's great."
Yeah.
Then, so I'd like for you to maybe explain a little bit about how this works. Then, do you all have the cash in the fund to just close the deal and then refinance it? Do you say, hey, we just go to the fund and get our down payment and we borrow the balance? What does that look like when that comes about?
If we've closed one, maybe 2 deals, I can't remember now, but at least one deal, all cash, and then put the financing on it later. So we always underwrite to financing the property. And everybody else I know, if they're going to pay cash for a property, that's fine. They're able to close it quicker and give some confidence to the broker or the seller that the cash is there. That's not a problem. But they will usually it makes sense to underwrite to a refi, whether that be a month after closing or whatever the case may be. But they got to replace that capital. So sometimes some people will have a line of credit that they draw on, which is great. It's like a credit card to go out and buy real estate. You got to pay that back, right, at some point. And so you're either raising capital or you have an institutional partner who's going to pay that back in some fashion, or you're going to have like a loan placed on it to pay back part of that capital, that drawdown that credit card that you've used. So there's some way, shape, or form you're going to end up putting debt on the property, not just keeping all equity there. So yeah, we that's usually how we do it. So we'll always underwrite to having debt in place, but we have closed deals all cash in the past.
As of recording, mid-August 2022, what are cap rates looking like?
Right now they've expanded. So most people are underwriting right now, if it's stabilized, right? So let's call it in storage, it's roughly 85% economic occupancy, 90-ish% physical occupancy. So if it's a stabilized property with those types of metrics, your cap rate's roughly, it depends again, the market, the asset, et cetera, but call it a 6, somewhere around there. Whereas if we would have asked me 6 months ago, let's say Charlotte, Let's say Charlotte, for example. So maybe it's a 6 now. If you'd asked me 6 months ago, it literally would have been like a 4. So there's been many deals that have come back to us, and like one we just underwrote yesterday, and nothing's changed for us. They came out to market like nearly close to $20 million, and they about 60 days ago, they're bringing it back to market with a roughly 30% price reduction on that, and the deal for us still doesn't pencil. Now that's a drastic example. We have seen others where they're knocking off $500,000 or $1 million or $2 million off the purchase price, but still the deal doesn't pencil, because while that might make sense 3 or 60 days ago, it still doesn't make sense today because they just raised rates 30 days ago. So how do we make the numbers work with that? So there's a disconnect. We ran through our numbers on offers and all that, and I keep track of how far we are off, on guidance or the purchase price based upon our offer. And we usually about 98, call it 90, 95% off, 98% off, as far as how far we are apart from the seller asking price. This last month in July, we were about 70, call it 75% off. So that spread has widened between what sellers expect and buyers, what we expect to pay for something. So it's slowed down, and we've seen that. So,
and it's always interesting to me when you have sellers who, even, I guess maybe they're approaching the idea of selling because if they can find somebody that's maybe looking to place some 1031 money or looking to do something, but it's almost like, why even present this deal to a company such as yourself, knowing what the underwriting has to look like in order to like that's what I guess is always kind of, I'm like, hey, you make money when people approach you with deals that work. They're able to sell when the deal works, and everybody knows what's going to make that deal work, especially in self-storage. And it seems like multifamily and some other asset classes, you can have some really outlying factors that could just drastically change a lot of stuff. But self-storage just seems like it would be an easier asset class to just pair one, and then everybody figures out what makes it work. Either they want to sell or they don't.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
But I guess they're possibly out looking for 1031 money or looking for a cash buyer that needs to place something immediately or something like that. So
anyway, it just depends. Yeah, like it depends on if it's a broker deal, sometimes the broker, it's just like selling your house. Somebody's going to sell their house. They call up 1, 2, or 3 agents, have them come over, do their agent presentation and tell them what they think their house is going to sell for and all that in today's market. Sometimes there's that one agent, oftentimes there's one agent who's like way above everybody else because they want the listing, and they'll get the listing, then they'll take it to market, and then they'll get all the offers in, and all the offers will be 10% less than that. But they'll say, look, boy, this is where the price is. Well, why didn't you tell me where the price? You knew that. You just won't get the listing. So in some cases, you have some brokers who just want the listing, and they're willing to kind of inflate the price a little bit to try and get that listing, and then the offers come in later on. They're way below.
Try to mash them together, or get them to agree.
And they say, okay, well, the market, quote unquote, the market has spoken, and therefore this is the price. And then the seller's like, well, if I go through this whole process again with somebody else, you don't want to do that because then it looks like something's wrong with the deal, and then it's going back to market with another broker. Like, you just never know how people perceive that. So that happens. And then other times, you're right. Like if you're in the institutional, like the larger type deals, there are plenty of groups out there who do have 1031 money, or they have a lower cost of capital and they're able to pay more for a deal than somebody else. And they're able to get that price or get close to the price that they want. So there's usually a couple of factors there on why it's kind of hard to get the price, to be where it needs to be to trade. Also, sometimes seller expectations, because they've put in a ton of work or they've done this and that or whatever, everybody sees it differently, right? If I had a pen here and that pen was given to me by my grandfather, who died in World War II, or, some crazy story, maybe like, whoa, this is worth a lot. Now you look at it, you're like, that's an ugly pen. I'm gonna throw it away. Like it's so stupid. I wouldn't even offer you $1 for it. Yeah. So yeah, there's that emotional aspect of things too.
Yep. Well, awesome. All right. Well, listen, Kris. So we have a couple questions we ask every guest that comes on the show. And the first of those questions is, what is the best book that you have recently read or are currently reading?
Well, there's a couple. I do like The One Thing. That's one. I haven't read it recently, but I've listened to it and read it, numerous times, audio book version of that numerous times in the past. And I think it always applies. That's kind of how I try to set up my day, is getting the most important things done first. And when I do that, I feel good. And when I don't do that, sometimes I feel like, I missed on something today, because you get so distracted by answering emails and doing all this kind of other stuff that doesn't really move the ball forward. So that book is really good. I recommend that to anybody. And then another one, actually Gary Keller's books. I have it sitting over here, The Billionaire Real Estate Investor. That does not apply to really to commercial, but just his thought process on going for units and, all the things in there that are like nuggets that you can take away. It's a great book, I think, and it can be applied to commercial real estate just as well as residential.
That book actually just came across my iPad. I didn't even know he wrote that. I didn't even know he wrote that book. I've always, The One Thing, or not The One Thing. What's the,
he wrote another one called Shift, and then he wrote another one called The Millionaire Real Estate Agent. And then Gary Keller, he wrote The One Thing also.
That's right. And that's the one that I'd always but I didn't realize he wrote that one, but the billionaire, but anyway,
The Billionaire Real Estate Investor.
I just saw it come across the other day. So, all right. What is a dream vacation that you have either taken or hope to take?
Oh, you know what? I like to travel and whatnot. We went to Disney World a little while ago. That wasn't a dream because that was a lot of work actually with the kids.
It's a nightmare. I've been there with my kids. Man, I'd rather be in hell with my back broke.
So I guess probably getting away to like Greece or something like that, because you see all the pictures of like the pretty water and like the mountainside stuff. So something like that with just me and my wife and just hanging out. And honestly, sometimes we just like when it's funny because I got 3 kids, 11, 8, and 2. And when my mom comes, when grandma comes, and she watches them or takes them out or whatever, it's like, do you want to go anywhere? Nope. Let's just sit on the couch and do nothing.
Just stay here.
So,
Used to you'd be like, let's go burn. And
exactly. Let's go party.
Now it's like it's nap time.
Exactly.
Awesome.
So,
well, listen, Kris, how can the listeners, if they've heard something that resonated with them and they want to get in touch, what is the best way for them to get in touch with you?
Typically LinkedIn. So I'm out there on LinkedIn. Just search, Kris, K-R-I-S, Kris Bennett, and you'll see me up there. And then you can always shoot me an email, Kris, K-R-I-S, @passiveinvesting.com.
Awesome. And I can vouch for the passiveinvesting.com guys. They are a great bunch who have always, it seems like to the investment world, you all give far more than you take from all of us as far as just wanting to assist and help and talk and offer advice and whatnot. So I would personally vouch for that. So anyway, listen, I want to thank you, Kris. I know you're a busy man, and I want to thank you first of all for being on the show today and taking the time to explain to us what the self-storage arm of passiveinvesting.com looks like. So
absolutely.
And listeners, as always, please head down and leave us a review. Leave us a 5-star review. We will be very appreciative of that.
Do it.
And while you're there, hit that subscribe button so that you can be notified of new episodes and new content as we release it. And again, I want to thank you, Kris. I want to thank you, listeners, for spending the last 30 or 45 minutes with us. And we really appreciate it. I hope everybody has a wonderful rest of the day.
Awesome. Thanks, Casey.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.